It's Brian Preston, the money guy.
Here's the two things in life, the two goals-based things that the author used as the motivation to think about for rebalancing. Number one is you have two things. One is not to be poor. So somebody who is older and scared, or somebody who's very risk adverse, their whole fear is I don't want to be poor.
I don't want to run out of money.
And if I go take too much risk or I do something, I'm going to be poor. So that's one goal-based thing. The other side of it is I want to be rich. The other is to be rich. Right. So a person that wants to be rich is like, well, we got to grow. We got to get the money. The army of dollar bills has to be working for you. So those two goals are in complete conflict with each other.
And by the way, being rich, we're not talking about like Robin Leach. We're talking about this is someone who wants to do the things they want to do, when they want to do them, the way they want to do them. So it's things like paying for college, stopping working, buying a vacation, whatever the case may be. It's just being able to do with your money the things you want to do with your money.
And that's a good point, because when you say one is not to be poor means you're not taking no risk. It means that you have enough money to provide an adequate retirement income.
That's right.
You're financially independent. And I think that's a good point to point out, is because, and this example was made in the piece as well, is that you could say, I don't want to be poor, so I'm going to go put all my money into a money market. But that's horrible. That doesn't mean putting all of your money, like this gentleman I was talking about, is not taking away the risk of the portfolio. Because we all know if you put all your money in a money market, yes, you've taken away market risk, but your purchasing power very much could be in risk by inflation. There's all kind of variables that could come into play. So it's a less risky asset, but it's riskier in the long-term goals.
I think you said that perfect. What the article really mentioned is that you have a much lower risk of being poor in the short term, but a much higher risk of being poor in the long term, and it's where you weigh that. And I think that was a great way to look at it.
So let's dig deeper into this goal-based approach, because it is kind of unique, and then we're going to bring it back because you guys, I know this stuff gets somewhat nerdy, but I want you to know this, that we're going to bring it back to tell you kind of what the best practices or what the money guy take is on it, what you should be doing with your portfolio. So hang in there with us as we kind of go through this goal-based approach before we kind of bring it back and marry the two concepts together. You have the first group, which is a young saver trying to build assets. So when you have a young saver, their goal is that their first objective is to be rich. The second objective is not to be poor, because the rich overweighs the be poor. So they're going to have the majority of their portfolio, probably 80% of the assets, in riskier stock growth type assets. The 20%, which is the conservative, is going to be primarily their income, because remember, the good thing about when you are working is that when the markets get beat up and things, you always go, well, I'm still working. I have my income. So you have yourself to rely upon. And then, of course, the conservative part, the not be poor part, is also buying into bonds or things like that. So what happens is that if you're somebody who wants to focus, you're a young saver and you want to build on this, if things continue to grow, let's just say that the bonds don't necessarily go down in value, but the stocks go up. If you had, because of your income and because you allocated that 20% to bonds, just because you got out of whack at, say, maybe it's 85-15 because the stocks grew, you might not need to rebalance, because the level that you had there as protection between your income and the fixed income was enough that you could let it keep growing.
That's right.
And that's what this is kind of unique in the fact that you wouldn't do that automatic rebalance.
Yeah, and this is what so that was a lot. And I'm not as smart as you, right? So I'm going to go ahead and throw that out there. So it was difficult for me to track on the article, but I started thinking about it in common sense terms. I'm going to use round numbers because I can do the math in my head, right? If you had $1 million portfolio and you determined that an 80-20 was the correct mix, and that 20% of that $1 million, or $200,000, should be on the conservative side, just because the portfolio goes up in value, and your portfolio grows to $1.2, $1.3 million, so long as your $200,000 stable base stays there, it's going to be a smaller percentage. But if that's like your comfort level, your not be poor level, the reason you're not having to rebalance is because the dollar figure is staying where you kind of had assigned it. That's really what he's saying here.
Well, let's go the other way, because I will tell you, my spidey senses are starting to kick in a little bit, is that, man, this could get dangerous really quick. I love the narrative that this creates, because it lets you communicate with people who might be thinking about risk in a different way. But this from an analytical standpoint could get dangerous. But let's flip it over and let's go the other side. Let's talk about the retiree.
Okay.
The retiree is obviously their first objective is to not be poor, meaning they want to have a good retirement. They don't want to take too much risk. And their second objective is to be rich. Because now they've given up on swinging for the fences. They're trying to hit singles for the rest of their life. They don't need to go find the next Facebook, Google, Apple, whatever the stock is out there. So they might very well have a portfolio of 80% bonds or conservative assets and 20% growth, since its objective is much smaller. So if we base it off your same system, if we had $1 million and we realized that 800,000 was going to be in conservative assets, and then 200 was going to be in growth, if it grew to 1.1, because of the stock, or we could say 1.1 to keep it simple. You're saying that 800 would let them keep it rolling.
I felt like that's what I was hearing in this article.
And that does make sense, because remember, the first objective is we know what our number is to keep us safe.
To not be poor.
And the fact that we have this 800,000 that's keeping us safe, letting us sleep at night, and just because the stocks have gone from 200,000 to 300,000, it lets that second objective of becoming rich kind of percolate and work. Let those assets keep growing. So that's a cool way. That's a cool narrative. I like what it does, and I think it is definitely useful. But I think we have to talk about what does that mean in reality.
Yeah. Yep.
We talk about, remember, rebalancing in some terms it's kind of like pruning your favorite fruit tree or your blackberry bush, like blackberry or blueberry bush that you have in your backyard, is that sometimes you have to trim things back so that you can get better growth, get better future long-term growth. And what I mean by that is when you have periods, in reality, what happens with rebalancing is that in theory, and you said this at the beginning, Bo, but I think it's worth repeating, is that if you have outsized performance, like the stock market, we know trees don't grow to heaven. I mean, stock markets go through cycles where it very well you could have 2 to 3 down years every decade. So it's nice when you get through those irrational periods if you have a process that pulls, like if the market makes 30%, wouldn't it be nice if you have a system that pulls some of those gains down and puts them into the undervalued assets, or the assets that now are out of proportion, meaning they're underweighted. That under this system, I mean, you could see how this thing could get really crazy. You could very well, like an 80-20 could very easily turn into a 93-7 very quickly. Now, I worry, and here's where I'm playing, and I'm just talking this out loud with you, Bo. This is not in the notes. We talk about this all the time, is that you get to a point, and this is why it's important to have a financial plan, is because it's not all the nuts and bolts of what your asset allocation could be. There is going to come a time where you look at it and realize, I've kind of won the game. So my goal is now, how do I not screw this thing up? And I still get reminded, it's easy to forget now because 2008 was a decade ago. We're seeing that, by the way, when we run proposals for prospects and brand new clients. One of the discussion points we've had to talk about here recently is all the scary data is falling off because it was 10 years ago. Now, does that mean that we're never going to have another 2008 or a bad correction? No, it just means we've had, I consider it part of the pluck effect, where when you pull, something down. We were so bad, the market, because it was called the Great Recession. It was the worst downturn since the Great Depression, that the market got its teeth kicked in so bad that it makes sense that we've had this prolonged recovery, this extended bull market. That kind of connects the dots on my common sense. But that means that at some point, I don't know when it is. I don't want you to think this is me trying to sell you some fear-mongering newsletter because I'm telling you 6 weeks from today the market's going down. Nobody knows that stuff, so don't pay attention. But you can start thinking, hey, I want to make sure my allocation is set up so that when the next downturn does come, that I'm not left holding the bag.
That's right.
And so if you figure out that your retirement plan requires this, and that you are 55, or and truthfully, if you're younger, you get to have, and that's why your allocation is going to be more aggressive, but you need to have all the different components working together instead of just knowing whether it's going to be, I'm going to rebalance quarterly or I'm just going to make it goals based.
Sure.
I mean, do you see what I'm saying
Yeah,
there? Build the bridge for me a little more.
There's a marriage between the two, and this is a really easy example. And we talk about this with prospects all the time because when you talk about portfolio management and portfolio construction, there are two pieces of risk that you have to consider: risk tolerance and risk capacity. How much risk are you comfortable with that you can still sleep at night? That's your risk tolerance. And then risk capacity. How much risk does it make sense for you to realistically take on? And this is the real easy way that we describe this to folks. Let's assume that tomorrow you have a $10 million portfolio.
Right.
It's real easy to not screw up with $10 million. I mean, it's going to be kind of hard to run out of that money. So there are two bodies of thought there. One is, I don't need to take any risk because there's no point. I don't need it to grow. It's going to provide for me for the rest of my life. The second is, I can be as aggressive as I want to be with that because even if I lose half of it, I still have $5 million. Both of those answers are right.
That is true.
And that's what's really interesting about portfolio management.
It has to be truly, instead of just being goals based, it needs to be financial planning based.
That's exactly right.
Because, and I thought, I will give credit to the article. It talks about how there was an older lady who, if you looked at her and said, what's her needs, you would think that it was to be rich because she was only living off of a portion. She was much more aggressive than she was supposed to be. But then you find out later that she gave just 7 figures to her favorite charity. Her desire to grow was to fund some of the organizations that she was very passionate about. And this is just like you have other people who just do not want to have any type of risk because they feel like it's not worth it for them. So those things are definitely, there is a tightrope. I always get that visual of somebody walking a tightrope between risk and reward of figuring out what they need to accomplish.